If you are a long-term investor, you will probably face the decision several times whether to buy a stock at a given price or wait a little longer. But how do you know if a stock's price reflects the true intrinsic value of the company or if its price is influenced by investor sentiment over the economic cycle? Welcome to Invest with Jiri channel. To make sure you don't miss any of my future videos, click subscribe. Let's take a look at what we are going to discuss today. Why use valuation models? Explanation of the Graham formula. Practical examples of calculations. Using automatic calculations and who was Benjamin Graham? Why use valuation models? Valuation models are a key tool for investors because they allow a systematic and objective assessment of the value of an investment. They help to identify attractive investment opportunities and minimize risks by analyzing financial ratios and forecasts. They provide a better understanding of the potential returns and risks of an investment and facilitate informed capital allocation decisions. Valuation models therefore serve as an invaluable tool for investors in optimizing their portfolios and achieving long-term financial goals. Explanation of a Graham formula. The Graham formula is a method for evaluating stocks popularized by Benjamin Graham, one of the fathers of value investing. For a better understanding, let's look at the formula. This is a modified formula based on oldschoolvalue.com, which better reflects current market conditions and offers a more realistic valuation of stocks. The adjustments to the formula are in the price to earnings for non-growth stocks, where Graham used a PE of 8.5, but we use a more realistic number of 7, and the growth rate adjustment, which we reduced from Graham's value of 2 to 1. Parameters in the formula. V is the result of calculating the intrinsic value of the stock, EPS or current earnings per share, PE with a value of 7 for non-growth stocks. This is a past average earnings figure, so the number is static. 1 as a multiple to the growth rate, G the company's 5-year earnings growth estimate times 4.4 corporate bond average yield, which is also a static average number. All of this divided by Y, which represents the current yield on AAA corporate bonds. Easy, right? It's important to keep in mind that Graham's formula only provides a rough estimate of intrinsic value. Different investors may prefer different methods and indicators when evaluating stocks, but I'll get to that later. Practical examples of calculations. Intrinsic value of Bank of America stock. Not to be all theoretical, let's look at the real-world example of calculating the Graham's formula on Bank of America stock based on my Google spreadsheet. I can get the actual EPS earnings per share value from finance.yahoo.com when I enter the detail of BAC stock. The value in the right column is 3.08. The PE price to earnings is set at 7. I will not change this. Next, I find the G or growth rate again on finance.yahoo.com under the Analysis tab. I'll scroll down to the bottom of the page and look for the line with next 5 years per annum. BAC has a value of 3.90%. I'll add it to the spreadsheet. Corporate bond average yield is a static number of 4.4. I will not change this. I'll add a Y at the end, so current AAA corporate bond yield, which I can find e.g. from ycharts.com, for this day comes out to 4.94%. For comparison, let's add BAC's current share price of $32.60. As you can see, the intrinsic value of Graham formula comes out to $29.90, while the current share price is $32.60. This means that the stock is 9% higher than the intrinsic value. Let's take a look at Dollar General stock. From the consumer defensive area, I picked ticker DG, which is priced by the market at $133.90. It has an EPS of 8.70, a growth rate G of -5.65%, and a required return Y of 4.94%. According to Graham's formula, the stock comes out at $10.46. In this case, Graham's price is much lower than the current share price, which would suggest that the stock is significantly overvalued relative to its actual price. Let's find a stock with a price lower than its intrinsic value. For example, let's choose Textron, ticker TXT, a company involved in the aerospace and defense industry. It has a current EPS of 4.63, a G of 17.50% and a required return Y of 4.94%. The current stock price is $79.33, but according to Graham's formula, it should be worth $101.04. Does this mean that this is an interesting investment opportunity? Yes and no. Beware, it's not that simple. You should examine the reasons why this is so. Try the simulation on other intrinsic value calculators like the discount cash flow model or the dividend discount model. Understand the whole company, its products, look at important fundamentals, etc. Using automatic calculations. So that you don't have so much work entering values into the calculator, I made an automatic calculator in the second spreadsheet sheet. At the top you just enter the ticker, e.g. J&J for Johnson & Johnson, and the calculator will calculate everything automatically. Online tools for Graham formula calculations. There are a plethora of websites calculating the Graham formula, but I have been unable to find a tool that calculates a formula with reduced values. As a result, the intrinsic value calculators then come out much higher than they are in reality. I recommend using my version, which you can download in the video description. Open the calculator and save it to your Google Drive, where you can work with it. Screener for finding undervalued stocks. There are sites on the internet where you can find stocks by the Graham formula and the current price. I'll mention grahamvalue.com/screener. Here you can choose a country, the parameters by which you can sort the list, and then you click on filter. It's fast and efficient. But again, I must point out that this is the original Graham formula with valuations that do not match today's company values. In fact, companies like Apple, Google or Tesla didn't exist in Graham's time. Who was Benjamin Graham? Benjamin Graham was an American economist, investor, professor and author who lived between 1894 and 1976. He is considered one of the most important investors in history and often called the father of value investing. By the time he was 25, he was working on Wall Street and his annual income was $500,000. In 1929, after the stock market crash, he lost almost all of his money. This lesson directed him to research stock valuation. Graham was a professor at Columbia Business School and his ideas about value investing are still studied and applied by many investors around the world today. Graham's approach to investing focused on finding undervalued stocks based on their intrinsic value and analysis of fundamentals. His ideas were summarized in the famous book The Intelligent Investor, which I discuss in one of my videos. Graham was a teacher and mentor to Warren Buffett, who is now one of the most successful investors in history and is also often referred to as one of the richest people in the world. Graham's approach to investing has had a major influence on the development of Buffett's investment philosophy and approach to investing. And that's all for today. Thanks for watching to the end of the video. If you learned something new, you can give the video a like. I look forward to seeing you next time. Have a great time and invest. Vasily.